Hello and welcome to Blue Chip Chats. My name is Gina DiGirolamo. I'm a certified financial planner, and this is the series where we talk through the technical and emotional side of financial planning to help you make informed decisions about your future. If you like our content, please be sure to like and subscribe so you don't miss the next episode. And thanks so much for joining. Let's chat. Today I'm here with Anthony Raimondo. Anthony is a chartered financial analyst and associate here at Blue Chip Partners. Anthony, thanks for joining me today.
Thanks for having me.
Absolutely. So today we're going to be talking about specifically bonds, how they work and how interest rates may impact them. And I think the overarching view here is that we want to talk about what that might look like for an investor when they have an allocation to equities and fixed income in their portfolio. So Anthony, if you could just start as a high level for everyone listening, what is a bond?
Sure. So a bond is a loan. Think of it that way. Most people are probably familiar with the idea of a mortgage, right? You're a home buyer and you need some cash today to finance the purchase of a house. So you have the bank write you a loan and give you money today. In return, you promise to pay periodic interest and principal payments back to the bank. Now, as an investor, when you buy a bond, the roles are reversed. So you are assuming the position of the lender. You're putting forward money today, giving it to a corporation or a government. And that borrower is contractually obligated to pay you periodic payments, which are interest payments known as bond coupons. And then at the maturity of the bond, they pay you the face value in the contract. And those two components, your interest return and your principal return, that's what makes up your total return as a bond investor.
Okay, and as an investor, we're often talking about yields and how that works for our clients. What is a bond yield, and could you define that?
Yeah, so first off, there are many different types of yield when you hear that term. Most of the time when you hear bond investors talk about yields in general terms, they're referring to what's known as yield to maturity. Okay, now, as a bond investor, you should understand that yield to maturity tells you a few different things. First and most simply, your yield to maturity is the annualized rate of return that you could expect if you bought this bond today and you held it to maturity. There's a second and slightly more nuanced interpretation that's important to unpack for our discussion today. That is, your yield to maturity is a discount rate, which you're applying to the future cash flows of the bond contract in order to equate the price you pay today for the bond and the future benefit you can expect to receive. And that discount rate is capturing things such as the time value of money, for example. $100 given to me 6 months from now is not as valuable to me today as, $100 in my pocket right now.
Sure.
The yield to maturity, it also captures different forms of risk, such as like credit risk we commonly think of. And it's just this balancing mechanism that forces the price today to be equal to the expected future benefit.
Got it. Okay, so what we're hearing all over this year in the news is how the Fed might impact rates and what interest rates might do for our economy. So at a high level, could you talk through how interest rates and bonds are correlated and what investors might expect there?
Yeah, so you may have heard this notion of interest rates and bond prices having this inverse relationship. Mm-hmm. And why does that happen? Well, I think it's easiest to illustrate with a very simple example. So let's suppose I'm an investor and I bought a bond that's paying me 5% per year. And if interest rates in the economy were 5% across the board, then I'm likely content because I can do no better than 5%.
Sure.
Well, if I woke up tomorrow and interest rates had increased to 6%, let's say, now my investment looks less attractive than it did the day before, and myself and other investors, we are likely to sell the bond we're holding to go out after the better opportunity. Mm-hmm. And what happens when investors all at the same time sell an investment? We know the price must adjust lower. Okay, so now tying it back to our discussion on yield to maturity and that idea of the two sides of this equation being in balance, on one side you have the price of the bond today, which in our example is moving lower. And on the other side, you have the future payment stream that's owed to you. So this side must also come into balance, and that happens through an adjustment in the yield to maturity effectively.
Okay. You mentioned the adjustment of that theoretical 5 to 6% change in interest rates. How are interest rates adjusted, and talk about how that works?
Yeah, so at the very highest level, there are a lot of different forces moving around interest rates in the economy at any given time, and oftentimes competing forces. And even some of the most sophisticated investors can struggle to understand where rates are going or what's moving them around at a given point in the economic cycle. But maybe we'll cover some of the key drivers of interest rates that you most often hear about. So the media likes to cover typically what are known as policy decisions, starting off with monetary policy. So here in the US, we have the Federal Reserve as our central bank, and many other countries around the world have central banks. And their goal is to essentially keep their domestic economies sort of on the rails. And they do so by using these monetary policy tools, which influence short-term interest rates. Now, in our country and many other countries as well, you have another policy arm, which is known as fiscal policy. That is covered by, or it's controlled rather, by the federal government, where they're making decisions on federal government spending and taxation of citizens and corporations. And that tends to affect longer term interest rates. And then finally, you have just kind of general supply and demand dynamics in the economy where investors are making bets based on different expectations for inflation or growth in the economy. And that also tends to affect longer term interest rates.
Okay, Anthony, so you talked about the inverse relationship between interest rates and bonds. Are all bonds impacted that way?
Generally speaking, yes. All bonds would have this inverse relationship between their price and interest rates. However, different bonds are going to be affected differently. For example, longer-term bonds are going to be more sensitive to changes in interest rates than shorter-term bonds would be. And then there's other payment features in a bond contract which could influence the sensitivity to interest rates, things like the bond coupon, or maybe embedded optionality, for example.
So, Anthony, to wrap all of this up, if someone has an allocation in their portfolio to bonds, or they're looking to move some of their assets into bonds, what would you say is a key takeaway for them?
Yeah, well, I would say having an allocation to bonds in your portfolio can provide you with both diversification and income generation potential. And understanding how changes in interest rates will affect your bond portfolio is important for managing your own expectations and helping you remain invested with confidence. It's really all about understanding what is the right mix of credit quality and maturities of the bonds in your portfolio to provide you with the right allocation to meet your needs.
Absolutely. And if you'd like to look further into the allocation that you have in your portfolio, whether that's to equities or fixed income, reach out to our team at Blue Chip. We'd be happy to help on that. And thanks so much, Anthony, for joining me today.
My pleasure.
And thanks for watching. Can't wait to chat again soon.